Morning, Market Chameleons, 9 a.m. on this Tuesday morning. How's everyone doing this morning? Dima, you there?
Good morning, Will. How are you?
Morning, D. We started right at 9 this morning, so let's get right to the disclaimer.
Okay. Good morning, everyone. Before we get started, keep in mind, Will and I, Market Chameleon, we're not registered investment advisors. We're not broker dealers. We're not telling you what to do. We're not giving you advice. We're just sharing ideas. If you need professional help, call your broker. That's what they're there for, to help answer your questions, provide you with guidance. There's the disclaimer.
Excellent.
Let's get started.
What do you want to look at first this morning, buddy?
Hold on one sec. Let's take a look at the pre-market report. We could do one of two things. We could continue on. There's some questions yesterday about the option block trade screener. We could continue going over that because we didn't kind of finish yesterday. We could also just talk about some of the stocks. What we intended to do yesterday in the morning was to kind of compare IBM, Google, maybe some other stocks, and talk about if a stock it could be fairly valued, but a good stock with something on the horizon could be a good deal even when it's fairly valued. So I was going to take a look at that comparison as well. So
let's finish up with the block trade screener, and then we'll see what kind of time we have left.
All right, so we'll go back to the option block trade screener. We'll go over some of those features we were talking about yesterday and kind of finish up with that, and then we'll come back to the IBM Google comparison. Let's first just check out what's going on in the pre-market hours. These are stocks trading in the pre-market hours. We have the most active stocks, biggest percentage gainers, biggest percentage decliners. Let's first filter out stocks that are higher market caps. I'm going to use this filter. Do stocks 20 billion market cap or higher. We see that 11 made the percentage gainers list, 30 on the percentage decliners list. From that perspective, looks like a more bearish bias at the opening. Couple that are at the top, looks like the first two are earnings related, not a tremendously big amount of shares or volume trading in the pre-market hours. There's Viacom that's kind of coming back from a big, that just recently had a big sell-off. And that was due to liquidation in a hedge fund.
Yeah, a hedge fund. I mean, the numbers they've lost seem incredible that this market has stomached it so well. But yeah, that was a big position liquidated along with a lot of the Chinese names, Baidu, Tencent. I think TME, I think, is 10 cents also coming back.
Yeah, so some of them, they're coming back. Large hedge fund had to Goldman, I think Credit Suisse, I forget who the banks were, but
all of them, literally everyone was involved. But the big losers supposedly are Credit Suisse and Nomura. Everyone else have protected their positions.
Yeah, and then just forced liquidated. So you could see kind of this is like a lesson where the market is at we're near the highs, right? There's nothing really volatile. There's not a big dislocation of values and assets. But even in this scenario, somebody had a swap on when against them, a forced sale. So even good assets can go down really fast when you're in a position where you're forced to liquidate your holdings to raise cash. And that's a lesson where that's why on the way down, things accelerate, because on the way down, things are triggered, especially we have a huge over-the-counter market in derivatives right now at these banks. And until something explodes, and you don't know when it's going to do it, how much it can affect, the rest of the market, and even large cap stocks. So
the hope is internally the banks don't allow that to happen, right? That's what their role is supposed to be.
Yeah, well, look, I think one of the things that even the regulator said and Greenspan said was that these derivatives are complicated. It's hard to even figure out how all these risks are interrelated because it's all behind the scenes. inside the banks, and nobody knows how it could. What does Warren Buffett say? They're like weapons of mass destruction. All right, and that's what happened. It was a derivative, I think, that caused this, right? A swap.
Yeah, it was multiple swaps, large swap positions.
Large swap positions, and it just kind of blew up. And that's a big risk right now. In the banks acted fast, I guess, to make sure they weren't going to take any of the losses, but the stocks had to get liquidated. And the other thing is, when you start liquidating these stocks, somebody it could trigger a loss somewhere else, right? That has to liquidate, right? So if another hedge fund was exposed somehow to this type of big move, they would be forced to liquidate. So fortunately, that didn't happen. But there you go. I think it was like a $30 billion hedge fund or liquidation. Let's kind of, just to save time, I'm going to go look at the unfiltered report really quickly. You got some small cap movers up top. BTSI up 50% on 3.1 million shares trading in a pre-market hours. This is a $37 million market cap stock. That looks like earnings related move. BIOC up 18.8% on 560,000 shares trading in a pre-market hours. That's a $69 million market cap stock. That one, again, that's also looks like it's reacting to earnings yesterday after the market closed. To save time, unless you have any specific questions, Will, on the pre-market or anything else, I'm just going to kind of move on to continue what we stopped at yesterday.
Sure.
All right, so let's come back to the option block trade screener. And a quick recap of what the option block trade screener is a lot of people come here to find ideas based on, big trades happening in the options, big blocks, which right now I think we have it defaulted to 200 contracts in a single trade or higher, but you could use the filters up here, to change that as low as 50. But the idea behind it is to see if anything unusual is trading, a big block is trading, and then trying to figure out, well, what is the thesis behind this trade? Do you agree with it, not agree with it? And it's never a good idea to piggyback a big trade unless you kind of do your research and have are more confident in an outlook, what's behind this trade. So you still want to go in there and start analyzing the trade, trying to figure it out. And just as an example, look, yesterday, more than 87,000 trades met these conditions. So you can't just piggyback it. You have to kind of take a look at it. What's going on behind it? What do we think the market is signaling here? And it's just a starting point. We went over these columns up top yesterday, starting from the time of the trade, the description of the option, some of the trade details of the option. We talked about some of the analytics as far as like implied volatility of the option, the exchange and condition, the delta of the option, the bid-ask spread. So we did this yesterday. If there are no questions on any of those specific things, I'll just continue to describe the rest of the data elements. So this way you could go in there and start using the filters, knowing what you're filtering. Let's take a look at, so since we did these top ones up here, let's go to a performance tracker and take a look at these data elements and how we could use them. So this is just a repeat from the previous main screen. It's letting us know the timestamp of the trade, the symbol, the option details, the option expiration, if it's a call or a put, the strike of the option, where the stock price was at the time that the option traded, the open interest of that option in the morning. So we talked about all this yesterday. So what else do we want to kind of compare? You know, because options, they're derivatives, they're statistical instruments. So we use kind of benchmarks to analyze that premium of the option. So over here, we could create a few, let me come back to this one actually. Before we come to this, this is the trade itself. So in SPY, 200 of this calls traded for 54 cents. Okay, the bid at the time was 54 cents, the ask was 55 cents. So as we said before yesterday, we could, what we talked about yesterday, we could infer that this trade, the incoming trade, was more likely a sell order hitting the displayed bid, okay, because it traded at 54 cents, which was the displayed bid at the time. So looking at this 54 cents, you know, we want to kind of analyze it a little bit further and say, well, what might he be thinking? What was the seller maybe thinking? What was the buyer? So, you know, we could start just comparing, well, what do we think this option would be worth using the Black-Scholes model if we gave it certain assumptions, right? And we're going to give it assumptions based on implied volatility. So options are priced in terms of implied volatility, and this kind of gives us a sense of, well, how expensive or cheap was this premium, because relative to how the stock moves. So option premium is based on the anticipation of kind of the gyrations in the stock, right? How volatile will it move? Because if you think the stock will not move at all, like it's going to stay at the same price, you know, that, and it's not going to move, then the option premiums will always be zero. It'll just be whatever the parity is. But you're not going to pay more premium. You're not going to pay time premium for something that's never going to move. So the more volatility it is, the more premium there is. So we're going to take a look at, well, how much is 54 cents premium? Is that a lot, a little? You know, how's that compared to how the stock usually moves? So if we took over here, if we looked at SPY and we said, if we took the last 20 days of SPY's volatility, so we took the historical volatility in the last 20 days, right, and we measured that volatility, we plug it into the Black-Scholes model. In this case, it's the binomial option pricing model. We plugged in that volatility. What would the option pricing model say this option is worth? So using the last 20 days volatility, they think that this option, according to the option pricing model, would be worth 96 cents. Okay. Tell me if there's any, you know, questions coming out of there. All right. Well, maybe what if we expanded that historical volatility to a 1 year, right? So you're smoothing it out. So the more you go out further, it's like averaging it out more and more days. So what if we just said, what if we assumed that going forward, SPY's volatility will be close to what the average volatility is on a 1 year basis? And obviously, like the last year has been more volatile because you got the coronavirus right in there. But if we did that, if we just assumed that it's going to trade similar to its 1 year volatility, we plug that volatility into the Black-Scholes model or into the binomial option pricing model. What does that model tell us this option theoretically should be worth? And that's $1.24. So we got 20-day volatility and then 1 year volatility. Okay, so we're comparing it to where the actual price of the option traded versus a theoretical price using those assumptions. Okay. If we use the average of the two, we'll just say, well, what if we gave 50% weight to the more recent volatility, 20 days, and 50% weight to the 1 year volatility, what would this option be worth? It's $1.09. So from that perspective, the volatility, so this isn't, remember, this is looking just from a volatility standpoint, not a directional, but just a volatility perspective. If we plug that volatility in, what would the premium theoretically be for this option? So we could see here that based on this premium wasn't that, it wasn't that high. So everybody okay with that?
Yeah, no questions yet.
Okay. So that's one way to compare it. Then we kind of come over here and we track, well, how's this option doing since this trade, right? So it's kind of like you want to sometimes monitor, because if there's something behind the trade, right? If there's something behind it and other people are seeing it and it's moving in the same direction of the trade, then maybe you want to pay even more attention to it, especially like if somebody's buying a call, the stock's going up, the option is going up, the implied volatility is going up. Maybe they come back and buy some more. Well, maybe that's a signal. Maybe I should pay even more attention and try to figure out what's going on here, because that's kind of your initial signal, like, well, maybe there's something more behind it than just, somebody just placed the trade as a hedge or whatever it was. There could be a story behind it and you want to start researching it. So this way we're kind of tracking that option from the trade and what's going on after the trade. So we see here traded at 54 cents. Since the trade, the latest snapshot is that the option is 47 cents, 48 cents, which is down 12%. If we use that midpoint, that's down 12% from the trade. So basically, that option is moving down, right? So the option is moving down, and it could be, one, we will compare what the stock price is doing since the trade. So the stock price came down a little bit, and then we could compare what the implied volatility of that option did as well. So if you're looking at it, if you're studying the trade itself, you kind of want to track it, right? Because if the idea behind it is I'm filtering out this large trade, looking at its notional, looking at how it traded, looking at the theoretical values of it based on the option pricing model and so forth. You also want to kind of, you're not going to jump on it at first unless you have very good reason to, right? Unless you think like, whoa, this option was way underpriced or way overpriced and it's very obvious to you. You might just want to start tracking that trade to see which direction it's starting to move, like what's developing post trade. All right, so that's over here. That's where we track it. So even if we go back, in time from yesterday, we could kind of track, well, what happened from, well, sorry, this was yesterday. Let's go back a little bit longer,
Hey, D, we did have a question. I must admit, I'm not sure. It just popped up. So Robert's asking, the option Dmitry is showing is selling at a discount to, I guess, historical volatility, HV. Price, does that make it a good buy? Is this question? Because
hold on a second, which was on here. So when you look at remember, we're just referencing those numbers. So from a volatility perspective, right, from an options volatility perspective, you trade using the Black-Scholes, using the binomial pricing model. It doesn't assume that you're just buying the option and holding it to expiration. That's not the assumption behind the model. The assumption behind the model is you're trading the volatility, the realized volatility versus the implied volatility in the option itself. Okay, so What the Black-Scholes model will assume is that you're going to first hedge the delta of the option. So like, for example, here, let's say an SPY, this updated, let's say an SPY March 31 put. It's a 395 strike, spot price 396. So it's a little bit out of the money. And it's assuming if you just did this option, right? Let's say you bought the put for $1.59. Okay. You bought this put for $1.59. And most people just buy it and wait, right? Like if you're not a professional options trader, if you're just getting in, what you're gonna do is you're gonna buy that option, you're gonna wait, and you're gonna hope that the stock goes down in price. All right. The option pricing model, that's not what it assumes. Not the Black-Scholes, not the binomial, not any of the option pricing models. What it assumes is the following: that after you buy it, you're buying it because the premium that's priced into this option, the implied volatility, if you're buying it, you're assuming that it's too cheap based on the actual volatility of SPY going forward. Okay. And what it's going to assume is the following: that once you buy this, and let's say you bought 10 contracts, just to make it easier, you bought 10 contracts in this put. Well, you're short, right? If you're long, if you bought puts, you're short delta. That means you want the stock to go down. So the option pricing model says, well, you don't care about the direction, you care about the volatility. So what you need to do is hedge that risk, that delta risk. Because if the option price goes up, I'm sorry, if the stock goes up, the option price will go down because it has that delta risk. Well, what is the risk, right? First, you need to know, well, what is my risk if the stock goes up $1 or if the stock goes down $1? So that's where the first Greek comes into, and that's your delta. Okay, so here's the delta, 42. So if you bought 10 of these, the option pricing model says you're short 42 delta. Well, what does that mean? Well, that means that if the stock, and the option pricing model is not exact, it's all estimates, and it's also assuming that implied volatility stays exactly the same, your delta, your gamma, time to expire, all of it, it's a snapshot. It says your immediate risk is if the stock SPY goes down $1, then these options will gain 42 cents. If the stock goes up $1, these options will lose 42 cents in value. Okay, that's your risk. So you need to hedge that. And to do that, you do it with the underlying, the stock. So let's assume that I bought 10 of these options for $1.59. Well, if I bought 10 of these options, I have to multiply 10 options times the delta, negative 42, times the amount of stock in underlying per option, which is 100. So this will tell me I am short 420 deltas. Okay, so think of it this way: 10 options at expiration would be 1,000 deltas if it's in the money or zero, but the most will be it's 1,000. Right now, you're short 420 deltas for 10 options. So what does that mean? Well, if I'm short 420, that means for those 10 options, the stock goes down $1, I make $420. The stock goes up $1, I lose $420. To hedge that, I need to buy 420 options. So I'm hedging $1, a $1 movement in the stock. And every dollar it moves, I have to re-hedge, okay, because I'll have a new delta. And that's determined by the gamma. When you're hedging your deltas back and forth, right, as the stock moves, what you're doing is you're scalping the stock based on the volatility. So the stock moves down $1, I have to buy more stock. The stock moves up $1, I have to sell some of my stock. So what you're doing is you're scalping the stock as this option is moving around. And what you're hoping is that the money you make from scalping the stock back and forth, the profits from there are higher than the decay in the option. All right, so that's how you would look using the option pricing model. Hopefully that, that makes sense. That's probably, a week's worth of webinars right there if I was going to like show examples, but I would just want to give you kind of a quick idea of what this is talking about. So it's not saying that this option is underpriced if you just bought it and held it, although it's similar, the premium is cheaper, but that's not what the option pricing model assumes.
Well, you did make it a 2-day webinar, which is very cool.
Yeah.
I think it was Mike H was asking, can you just refresh how you got to that screen?
So to get to the option block trade screener, we come up here under options. Oh, I'm sorry, under screeners, option block trade screener. So some of the filters that you could use, you could just kind of track. So we have some presets here, like for example, bullish flow, bearish flow. So bullish flow would be, you could see up top what the preset filters are, but the idea behind it is kind of to see where how the options that are trading and kind of moving, showing a a bullish directional. So the options traded in a bullish manner, and then the stock and the options are behaving in a bullish manner post trade. Okay, so they're kind of getting pushed the same way as the trade. So that would be under the bullish flow. Bearish flow, it would be the opposite. Okay, so the bearish flow, IWMWC, those yesterday, people were trading in a bearish manner, and then there's confirmation in the option and the stock moving post-trade in that direction.
Great.
Hopefully that helps, yeah, because we did this is the second day we're on that option block trade screener, and it wasn't on the schedule, on the agenda. It's just to try to answer some questions.
Yeah, we did just get a question pop up, and maybe you just want to give your opinion on it. Abhishek is asking, he would love to see a scalping webinar. And I'm not sure that's anything you or I have ever participated in, is scalping.
Yeah, I mean, I would have to kind of think about how to do that. I traded that way for, I know how to trade that way. I've never actually like sat down and like thought about how to, because there's lots of nuances in there, right? It's not a simple thing because there's always like exceptions. You got to kind of look at what if volatility is going down, going up, so it's not simple. I have to like kind of think about how to draw it out, and I think it would probably be like a week just to go through some of this stuff, maybe longer, because I don't know. Well, when we got our training, I would say it took a good while through the training, before we started trading for a trading firm. It took a good while to go through it, and it also depends how knowledgeable you are on options and option pricing models before you could even like kind of go to the strategy itself.
Yeah, you're right. It's a tough space.
It's not like a half hour or even 1 hour. It might, depending where you are, how knowledgeable you are in the options, it could be a good month of lessons, and a lot of experience too.
One thing, we only got about a minute left. The one thing I wanted to remind everyone is we are having a webinar tonight with one of the big chameleons out there, Raj. He's been an active user, like a lot of people on the chat this morning. They're all active users, but he came to us and wants to present some ideas he has around earnings using Market Chameleon. So everyone should register for that. I'll put the link in the chat right now. That is at 6 p.m. tonight. We will be streaming on YouTube as well, but if you register for the link and do it through Zoom, you're going to be able to be live on it if you want, correct? Isn't that how it's working tonight?
Yeah, I think, exactly. If you on Zoom or on YouTube, you'll be able to get, but I think on the Zoom, we'll do different because, Raj is coming on, and it's brave of him because he's a user, but he's been a user for a long time, and he answers questions. He's very good with the Market Chameleon, so he wanted to kind of just talk about how he uses it. And believe me, it's pretty brave. It's not easy to turn on the camera and start talking in front of people. So that's, we really appreciate that he's going to come up and do it. And we're going to, we hope everybody supports him with that, and that he said, he wants to make it more interactive with the community. And if somebody wants to come up and ask a question, if you're not comfortable typing the question, you want to come on and just ask the question, we're going to try to do that, either voice or video, and kind of open it up to other members to be able to interact and kind of exchange ideas that way.
Yeah, and Raj, who's again super active on the Discord group that was created by the Chameleon community, he thinks this is going to be very helpful for the newer people using the Chameleon. So anyways,
Yeah.
it should be an interesting evening, 6 p.m. tonight. Put the link out there. Thanks so much, Dima. Great show as always. Bringing it.
Yep. Thanks, everyone. Stay safe. Have a good trading day. Hope to see you guys tonight.